Good morning. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on our heritage.org website on all of these occasions. I would ask everyone here in-house to make that final courtesy check that cell phones have been turned off. It's always appreciated. And, of course, we will post the program on our Heritage homepage following today's presentation for your future reference. Hosting our discussion is Norbert Michele. Dr. Michele is a research fellow in financial regulations in our Thomas A. Rowe Institute for Economic Policy Studies. He writes and studies on the housing finance issues, including the reform of Fannie Mae and Freddie Mac. He also focuses on the best way to address difficulties at large financial companies. He researches monetary policy and other issues related to the Federal Reserve as well. Before joining us here, he was a tenured professor at Nicholls State University in their College of Business. He had previously served Heritage as a tax policy analyst, and he earned his doctorate in financial economics from the University of New Orleans and earned his bachelor's in business administration in finance and economics from Loyola University. Please join me in welcoming my colleague, Norbert Michele. Norbert?
Thank you. Good afternoon. Welcome to the Heritage Foundation. Over the course of the last 18 or so months, we've been heavily engaged in monetary policy, and today's event is the sixth in a series of these public monetary policy events that we've been having here. We still have a few more in the works for the remainder of the year, and we're also planning to work much more closely with Cato, the folks over at the Cato Institute, who have launched their new Center for Monetary and Financial Alternatives. At the end of March, for example, we plan to have a rules-based event panel on Capitol Hill. So there's something to watch out for. Watch for the official announcement to come soon. We both, Cato scholars and I, believe that there are better alternatives to today's discretionary monetary policy and the financial regulation framework that we have. So we're very excited about working together to get these ideas out there. Today, the focus is squarely on monetary policy, which of course is one of the key components of the economy. Throughout history, there have been several incidences that have highlighted the importance of getting monetary policy right. And just two that stand out, of course, would be the Great Depression and what some people are calling the Great Recession that we recently had in 2008. What's kind of funny is that the debate over the Fed's role in these two incidents is very similar. Was monetary policy too loose for too long, thus contributing to the crisis? And was it too tight at exactly the wrong time, thus making everything worse? The debate is essentially the same. Does the central bank perform well in its attempts to engineer a stable macroeconomy? So we've had a whole series of experts come here to Heritage to discuss these issues, Federal Reserve performance, and various approaches to monetary policy reform. And we've been able to demonstrate that the Fed's track record does, in fact, warrant a critical appraisal, to say the least. Overall, after Congress created the Fed in 1913, recessions have not become less frequent, they've not become shorter, and they have not become shorter in duration, and output has not become less volatile. So how might we do better? Well, one way would be for Congress to require the Fed to implement a rules-based monetary policy. Two economists actually won a Nobel Prize for this idea back during the 1970s, but central banks have never put the idea into practice. And they've argued instead that discretion is necessary to conduct monetary policy. In one sense, this shouldn't be too surprising because no bureaucracy is likely to support rules that reduce its active role in pretty much anything. So today's event with Professor Taylor helps us highlight all of these issues. Professor Taylor is the George P. Schultz Senior Fellow in Economics at the Hoover Institution and the Mary and Robert Raymond Professor of Economics at Stanford. He also chairs the Hoover Working Group on Economic Policy and is the director of Stanford's Introductory Economics Center. He received a BA in Economics summa cum laude from Princeton in 1968 and earned his PhD from Stanford in 1973. He's widely regarded as an expert in monetary policy, and he developed a well-known policy rule that bears his name, the Taylor Rule. His book, Getting Off Track, was one of the first on the financial crisis, and his latest book, First Principles, develops an economic plan to restore America's prosperity. Professor Taylor also won the 2012 Hayek Prize for that one. He served as a senior economist on President Ford's and President Carter's Council of Economic Advisors, and also a member of President George H.W. Bush's Council of Economic Advisors, a senior economic advisor to Bob Dole's presidential campaign, also to George W. Bush's 2000 presidential campaign, and to John McCain's campaign. He was a member of the CBO's panel of economic advisors from 1995 to 2001, and from 2001 to 2005 served as the Undersecretary of Treasury for International Affairs. Professor Taylor received the Bradley Prize from the Bradley Foundation and the Adam Smith Award, as well as the Adolph G. Abramson Award for the National Association for Business Economics. He was awarded the Alexander Hamilton Award for his overall leadership at the U.S. Treasury, the Treasury Distinguished Service Award for designing and implementing currency reforms in Iraq, and the Medal of the Republic of Uruguay for his work resolving the 2002 financial crisis. So he's no stranger to the policy world of D.C., as any of the staff out here knows. At Stanford, also, he was awarded the George P. Shultz Distinguished Public Service Award, as well as the Hoagland Prize and Rhodes Prize for Excellence in Undergraduate Teaching, something we don't hear a lot of anymore. He is a fellow of the American Academy of Arts and Sciences and the Econometric Society, and he formerly served as vice president of the American Economic Association. In addition to teaching at Stanford, John has previously held positions as professor of economics at both Princeton and Columbia. So we're very happy to have Professor Taylor here today to talk about rules-based monetary policy, including the one that bears his name. And after his presentation, we'll have some time for question and answers. But first, please help me welcome Professor John Taylor.
Thank you very much, Norbert. Thanks for inviting me to participate in this series. I wish I could be here for all of them. So it sounds terrific. I also enjoy being back to the Lehrman Auditorium, which I've come to talk about some of those books you mentioned in the past. It's a great venue, and I appreciate Heritage Foundation for their willingness to have me, put it that way. But as you indicated, I want to today talk about something I haven't talked about here before, and that's monetary policy, one of the things that are near and dear to my heart and have been for my whole career. I'm going to talk a little bit about that. What I'd like to do is kind of organize my remarks around a series of answers to I'll call frequently asked questions about this topic, because I get it all the time. It's given me the opportunity to put it together, and I think in a somewhat coherent way. But before that, I want to kind of review a little bit of the history of research that I've been involved with and others over the years, because I think it puts what we're doing here in context and actually answers a lot of the questions that people have about this important issue of rules-based monetary policy. I think you learn from a lot from history anyway, and I have a bit of a history to talk about at this point. Believe it or not, I started working on policy rules 50 years ago. I was fortunate to take a course as an undergraduate in macroeconomics by a professor named Phil Howry. Unfortunately, Phil recently died in a biking accident in Colorado. But he gave a terrific course, an unusual course. It was a course, it wasn't this sort of static Keynesian ISLM course. It was a course on the dynamics of the economy. How the economy evolved over time. Emphasis a lot on business cycles and dynamics. We would call it stochastic dynamic models now. So as a sophomore, I took this course, and it's really the only kind of macroeconomics I knew at the time. I just was fascinated by it. But what was really clear from this view of macroeconomics, which is quite modern, is that you could not think about monetary policy in any other way except as a rule, as a contingency. Because any effect on the economy would take place over time. It's a dynamic economy, evolving over time. It really didn't make any sense to think of one-time discretionary changes in policy. I mean, it just didn't make sense. And it wasn't like there was a debate, it just the way it fell out. Now, of course, there was a big debate at the time about monetary policy. Milton Friedman arguing for fixed money growth rule, historical debates about the role of the gold standard and policy rules versus discretion more generally, a very hot topic. Again, to me, it really wasn't much to debate, so I just proceeded in a fascinated way to get started. And in a couple years before I graduated, I was working on finding optimal policy rules based on these dynamic models. Wrote a paper in 1968, issued it in the econometric research program at Princeton, on how to find good policy rules in one of these dynamic models. It was a money growth rule where the money supply would respond to certain events in the economy, but it was a rule nonetheless. And I'd say at that point I got hooked on this and haven't let it go since. Right away I was thinking at that point I was going to go to get an MBA. I'm going to get an MBA at Stanford, and right away I said, well, I don't want an MBA. I'm going to get a PhD. I need a PhD to study this subject. So I changed from the business school to the economics department and got a PhD. At the time, macroeconomics was quite a bit of ferment, so I decided I'm going to work on the statistical aspects of this subject. And due to the extraordinary advice of a mathematical statistician, Ted Anderson, who's still a good friend, he's 96 years old now, we worked on ways to find policy rules that were robust to the fact we didn't know the model of the economy. How would you change your policy when you don't know what's going on? It is a tough problem to model in macroeconomics. I say the conclusion of that research, really kind of high-powered statistical research, was that you could get a lot by a simple kind of rule. Don't get so complicated. You get a lot by a simple rule. And it was a general theorem, but that came out of that work. And it was about that time, by the way, that rational expectations started to come into our thinking about policy. And Norbert mentioned Kydland and Prescott. To me, that was an extra reason, on top of all the things I'd seen already, to think about monetary policy as a rule, because they demonstrated the dangers that could occur from a move to discretion, absolutely a suboptimal kind of policy, and the importance of time inconsistency. So it's another really important aspect, which, as you mentioned, won the Nobel Prize. There was another thing that happened with bringing rational expectations, forward-looking thinking into play, and that is we realized that part of our modeling of the economy was kind of artificial. We kind of imagined that expectations were kind of do whatever you want with them. If they want to evolve slowly, adaptively, whatever you need to do to get a reasonable description of the economy moving, you just do it with expectations. Well, rational expectations say, hey, you can't do that. It's got to be roughly consistent with the model. I mean, people are out there making their forecasts, not just willy-nilly. They're thinking about the future. So that forced us to think about better models of this wage price process. I sometimes call it staggered wage and price setting, the only way you can make sense of the dynamics of the economy in a rational expectations world. So all through this process, we're developing theories and techniques and model solution methods that I think enabled me and others to build models, and I emphasize models, that were sophisticated enough to at least get a handle on evaluating monetary policy. These are monetary models, but they're quantitative. Some were small, some were big, some were international. Just trying everything we could to find out, what does theory tell us that the monetary policy rule should be? Always looking at rules, no other way to do it. And soon what we found is that this goal of finding a rule for policy, and I would say this is not just thinking about it abstractly, but finding something that could work, something that would be useful to policymakers. And what was happening is that was coming out of this method, and I've sort of built up to it, were very complicated rules. If you got a complicated model, sometimes you're going to get forced into a complicated rule because if everything's in the model, you're going to put everything in the rule. It's sort of like a natural tendency. And it became really questions, where is this research going? Yeah, you like rules, I like rules, but the computations and the theory was taking us in a way which really was too complicated. And anyone who spent time in policy knows it can't be too complicated. So there became a period where strong rules-based people like David Laidler, monetarist David Laidler, sort of say, we got to give up. This was going nowhere. We just got to use discretion. Sorry. But other monetarists, like Alan Meltzer, said, no, let's keep at it. And he encouraged me, and he actually invited me to give a talk at one of his conferences he held in Pittsburgh. So think about it some more, Taylor. And so I started working with this goal of a simple way to take that theory and those ideas and make it more workable. And that's really where what later became the Taylor Rule came from. Working with graduate students, John Williams, just one of my students at the time, he's now at San Francisco Fed president. Volker Wieland, who's now in Germany, Council of Economic Experts. So I'm working, trying to find a way to make sense of all this. Could there be a simple type of rule, maybe even specified mathematically, maybe even linearly, that could embody these ideas of what good policy is? And I think the answer was yes. What we came up with was first a decision that the instrument ought to be the interest rate. Well, that was a little different. In fact, it drew a lot of suspicion. Back in the early 90s, the Fed didn't even talk about the fact that it was setting the federal funds rate. That was a mysterious thing behind the scenes. So to say you're going to have a rule with the federal funds rate being the variable you're determining, a lot of suspicion, a lot of criticism. Well, eventually, of course, that changed as the Fed became more transparent about its interest rate. There's also evidence that if you have a goal or a target for price stability, also, of course, a goal for stability in the economy, that you ought to be reacting to inflation as it moves away from a target. Of course, you got to have a target. Well, what's a simple target? We chose 2%. Well, 2% actually has now become the most common target of all central banks. It wasn't then. But it made sense. I thought maybe we chose a number that was too high, but we chose it. Then you had to decide, well, what should the central bank do when inflation moves away from the target? Well, it's got to change its instrument. Well, how much? Well, the theory said that it needs to raise the interest rate by more than 1% if the inflation rate rose by 1%. A number 1.5 seemed to make sense, easy to remember, not too far away from what our numbers were telling us. So the interest rate would increase by 1.5 percentage points if the inflation rate rose by 1 percentage point, and the reverse. It also made sense to have some sense that you're reacting to the real economy, GDP. And I think to some extent that idea came from the old view of money growth rules, because in a money growth rule, if you have money growth constant and the economy picks up, the interest rate's going to rise. And so building that into a rule is important too, plus the models told us the same thing. So you have a reaction coefficient to GDP, at least relative to its potential. About a half seemed about right based on the simulations and theoretical research. So that's what that came from. And then finally, you needed some kind of a baseline to judge these interest rate decisions with. And what I mean by that is, what is the equilibrium short-term interest rate that you want to be aiming for? Pretty important if you're setting the interest rate to have some concept of where you're going. So we thought about it in various ways, came up with 2% real. 2% real federal funds rate is kind of the equilibrium, or 4% nominal if you got a 2% inflation target. And so that was it. And that's really where the Taylor Rule came from. In simple terms, do a little substitution. It says the interest rate should equal 1.5 times the inflation rate plus 0.5 times the GDP gap plus 1. That's it. It's hard to see how it could be simpler. And so that's the story. And so there's a lot that goes into something like this. And I emphasize that because it's not just, and I'll come to that with some questions, it's not just writing it down, but there's a tremendous amount, I'd say years, there's 25 years there of thinking and working on it. Now, what's amazing to me is what happened later. And this really is where the theme of policy rules based on the Taylor Rule. Because it turned out that work first presented in 1992. In 1993 and 1994, the federal funds decisions of the Fed matched that formula almost perfectly. And people said, hey, what's going on here? That hadn't happened. I don't think we'd be calling the Taylor Rule, quite frankly. But what happened? So it got people's attention, and it looked like what was put forth as a normative was actually procedure, normative idea was becoming positive, explaining things. Next thing amazing happened is roughly for another decade, it was pretty close to this. And if you looked in the past, recent past, it was pretty close to this. Next thing amazing happened, people originally the San Francisco Fed, but Rich Clarida, Mark Gertler, Jordy Galley said, hey, look, if you look at periods where policy seemed to be working well, we have pretty steady inflation, price stability, pretty steady economy, not a lot of fluctuations. Those are periods where the interest rate is being set pretty close to that formula. Slightly different versions, but pretty close to that formula. And even more amazing, the bad periods were when the Fed was off of that formula. So it's pretty remarkable. That all occurred after this. It's because you had, experience with it. And it's really just a description of events that followed, this history that followed. More amazing, this same phenomenon seemed to be true of other countries that we looked at, and other people. But at this point, the we is so broad because so many people were working on this because it was, I think, a very fascinating set of developments. There's other things to note that I think are surprising. One is let's call this the international version of this. The models that we were working on said that if, not just the United States, but if other countries in the world would follow the same kind of rules-based policy, and again, it has to be exactly the same. In fact, they could have different tastes, different coefficients, but roughly the same kind of formula, then you would automatically get a better global economy. Things would work better globally. It was almost as if countries were cooperating because they're kind of, you do your thing, we do our thing, but it was bad. Economists call it a kind of a Nash equilibrium that's close to optimal. So I call it a nearly internationally cooperative equilibrium, nice. And I think what is true of this period of roughly the 80s and 90s until recently is it was pretty nice. And so it's consistent with the theory. Again, the international side coincided with the theory. Another thing which I would point out was a surprise to me was how robust the calculations were to different types of models. And I talked about the model work we were doing, but lots of other people had different models. And within a fairly wide range, these kinds of procedures seem to be robust. Not exactly, but if you had more complicated things, they weren't robust. They kind of fell apart. You could also explain puzzles that people had trouble with before. So, for example, a spurt in inflation people would find would be causing an appreciation of the currency. Well, that's kind of the opposite of what you think if you're going in a period of inflation. You've got a depreciation currency. But if you thought about a policy rule on top of that, a spurt of inflation would call for a higher interest rate, which would tend to appreciate the currency. So there were things like that as well. So to me, it was pretty amazing. But then something else happened. In a sense, this is, to me, the tragic part of all this. Not tragic for the theory and the ideas, but tragic for us. Because I think what happened, I pinpointed this originally 2003, 4, and 5, writing about it in 2006 and 7, is the Fed began to deviate from these things that were working. This is a period where some people call too low for too long period. Interest rate was extraordinarily low compared to this period, the Great Moderation period, where things were working well. And lo and behold, things start to blow up. I think the reason had to do with the excess risk-taking, search for yield. Not the only thing that was going on, of course, there's regulatory issues, but definitely before the mess, before the panic, the Great Inflation, the Great Depression, the Great Recession, there was this change in policy. So to me, again, tragic in a way, but also confirming this thing that we have been finding over time. And I think if you now look at what's happened, say now for roughly 10 years, you've seen a massive move away from more rules-based policy. It's not just the interest rate, it's the other kinds of policy operations which are hard to specify as rules, the quantitative easing, the forward guidance that keeps changing all the time. And I think that in itself is another demonstration. Harder to specify the reasons, but it seems to me quite clear that it's causing problems. And of course, internationally, we have certainly moved away from anything that could be called nice. Spillover is talked about all the time. Macroprudential policy being used in countries that didn't use it before because they're being affected by these policies. So it seems to me that's the situation. And in a sense, this is why people like me, I think many of you, would like to go in a different direction with policy. I call it renormalized because I can see aspects of where we were before that worked well. The world is different, so it might not be that, but certainly don't think of a new normal like we've had in the last few years. And that's why I, 2 or 3 years ago, gave a speech at Cato. It was called Legislating a Rule for Monetary Policy. And when I came up with these ideas about rules, I wasn't thinking about legislation. I was thinking about ways to make monetary policy better. But in light of what has happened, it seemed to me we need to think about legislating a policy rule. So that proposal was based on experience that we have had on legislation with monetary policy, which I studied in legislative history. It used to have money growth targets that the Fed was supposed to report on. These were taken out of they were put in the Federal Reserve Act in 1977 and taken out in the year 2000. Nobody complained about it much of the time because the monetary aggregates had lots of problems with velocity changing, technology, the use of money, which made them less useful. But nothing was put in its place. It was like there was a void. So the simple idea was say, well, let's fill that void. Let's fill that void with some legislation that would require the central bank, the Federal Reserve, to specify its strategy, its rule for setting the interest rate. Seemed pretty straightforward. And that's why I'm strongly supporting this legislation that came out of the House Financial Services Committee recently. It's Section 2 of H.R. 5018 of the last Congress, because that basically does something very similar to this. Of course, it's not exactly the same, but it has an attractive feature that is a degree of accountability, transparency that I think goes in the right direction, but doesn't tell the Fed what its strategy should be. It doesn't tell the Fed to follow a Taylor rule, thank God. That's the Fed's job. That's the responsibility of this independent agency, but it should report what it is and be able to change it if it wants to, but also say what the reason is for the change. So I think that's very useful. Now there's hearings about this coming up. In the past there were hearings about it. And in the meantime there's other legislation such as the Audit the Fed bill, which I think reflect some of the same kind of issues and concerns that I've gone through in this history. But given this history, now let me try to raise some questions and answer that the people have asked. So one is, I said, it's often said that monetary policy based on the Taylor rule is mechanical. That's actually frequently said. Is it true? No, it is not true. And in fact, I have a quote from my original paper. An objective of this paper is to preserve the concept of a policy rule in an environment where it is practically impossible to follow mechanically any particular algebraic formula that describes the policy rule. That's not how, you don't sit down and follow a formula like this when you're doing policy. Some judgment is required, I believe. And maybe we can find a better way to do this, but the word mechanical is used pejoratively in describing this. It's just not appropriate. Second question, it's often said that the Taylor rule was the result of a curve fitting exercise. You just looked at what the Fed was doing and described that. That is not true. As I mentioned to you a few minutes ago, a huge amount of monetary theorizing, quantitative work went into that kind of calculation. If I had simply done a curve fitting exercise, it would have been I would have got a completely different formula. Remember, I would have had to gone back to the 70s, 60s, in bad old days, and it would have not got that number. So that's a frequently misunderstood idea, but it's not true. I did try to show that during Alan Greenspan's term, that there were features quite close to that, but emphasized more the deviations than the similarities. What about the uncertainty about the output gap? Doesn't that mean the Taylor rule is useless? Well, I don't think so. It means policy is difficult. If you're a Federal Reserve official, a central bank official, even if you're sole goal is targeting inflation or price stability, you've got to look at the real economy. You've got to make a judgment call of where you are relative to normal. It's not easy. It doesn't mean a rule is bad. It means policy is difficult, whether you use a rule or not. Zero bound on the interest rate. Doesn't that mean that a policy rule like this is useless? We actually, in all that work I summarized a few minutes ago, always had a zero interest rate in mind or concern. Whenever a simulation resulted in an interest rate actually when it hit 1%, we would switch to a Milton Friedman money growth rule. That seems to me the thing that if you based on your policy and your thinking based on what we knew, it wouldn't say some massive quantitative easing. It wouldn't say throw out everything you knew about rules. It would say when the rate hits zero, you have a policy rule with money growth. And that's how we did all those simulations. So in other words, it was an interest rate rule within limits. And those limits basically with a zero bound. So it's not true to say that this kind of thing is useless in that context. What about the equilibrium interest rate in the Taylor rule? As they mentioned, it's 2% real, 4% nominal. Many people now are saying, hey, that's too high. Growth is slower. It's part of the secular stagnation argument. Growth is slower, shouldn't we have a goal maybe of a 3% federal funds target in the long run rather than 4%, or maybe even 2%, zero real? I don't really know. I don't think so. I don't think we have a lot of evidence for that. I noticed the FOMC poll that they have, they've lowered their equilibrium nominal federal funds rate from 4 to 3 3/4, so it's not a big change yet, but they seem to be moving in that direction. They may be right. I think we need research. That doesn't mean you don't use a policy rule. That means you have some adjustment of what that rate should be. I don't think it's needed, but it certainly doesn't rule out the notion of rules. Now, there has been recently a whole revival of criticism of policy rules in general. Narayana Koshulakata of the Minneapolis Fed, Larry Summers have been reviving this. And based on debate I had recently with Larry Summers, the notion is that we can always do better with discretion than rules. Larry would said to me in this debate, if I were sick, I had a doctor, I'd want a doctor that prescribes me the right medicine. I don't want him to follow a rule. I just want him to get me the right medicine. It's a very appealing kind of concept. Of course, you have to have the right doctor. The truth is, though, what we know about medicine is really not that straightforward. The idea of checklists for doctors shows it can work a lot better if the doctors follow their rules, follow a checklist. And that's kind of one of the major findings in medicine. Of course you have to have procedures and checklists. Of course you have to have rules for operating. But nonetheless, there has been this revival of interest and discretion completely. Now, some wonder if a Taylor rule type thing is just too much leeway. Shouldn't we go back to the gold standard? I would like to find a way for there to be less leeway. I don't think we're there yet, but there is some constraints that comes from that. Here's a question. Doesn't the policy rule legislation require that the Fed follow the Taylor rule? No. It does ask that the Fed compare its strategy to the reference rule, which is a Taylor rule, but there is absolutely no requirement that it follow it. That's kind of a false criticism. It's out there. I think you need to take that and put it in its place. Well, what about alternative rules? I would be the first to say, especially if you read what I've written over the years, that there are alternatives that should be considered. Let me just talk about nominal GDP targeting. I wrote papers about that in the 1980s. I think the Taylor rule delivers a pretty good outcome if your goal is nominal GDP stability. I mean, the metrics or the criteria that we were using to find out what a good policy rule was were how stable real GDP and the price level or inflation were. They combined to a statement about stability of nominal GDP. So it really becomes a question about how do you go about getting stability of nominal GDP? And I think it's not enough to say you want it. You have to say how you get it. This is a issue which I've always worried about in my work and talked for many, many hours with Milton Friedman about. Milton was so sure that any kind of policy rule had to be about the instruments of policy. The lags in policy, the difficulty of accountability if you don't do that. So we'd always emphasize, whether it's the money supply or the federal funds rate, some notion of what the Fed does, what the central bank does, has to be part of the policy rule. So nominal GDP targeting, if it says what the Fed should do, then let's talk about it. But in the meantime, I think we got a pretty good rule that gets you stability of nominal GDP. What about adding other variables, the stock market, the exchange rate? I don't think it's a good idea. Those variables are quite volatile. They cause volatility of the interest rate. And you could think about the 2003, 4, or 5 period. Many people say that's where the Fed should have been reacting to the housing bubble. Maybe. I think if they had just followed a better policy at the time, we wouldn't have had to worry about that. So before you start saying they got to react to other things, make sure they're doing the right thing in the first place, not causing the instability, if you like. There's other questions, but let me kind of wrap up, because I'm sure you have questions that I have not listed. And I think the most basic one is, can we improve on the Taylor rule? And I'd say absolutely we can. One of the things I think about all the time, I'd like my students to think about. I think it's a good place to conclude, because these ideas, 20, 25 years ago, were put out as examples for discussion. As I indicate, they were based on years of research by me and many other people. I'm, of course, surprised that they have attracted the attention, that they're still being discussed. And it's amazing. But it seems to me the important thing, and this is really in keeping what Norbert said at the beginning, the important thing is there is real advantage to having a strategy or a policy rule for the central bank. And there's debates about how to get it, but that's a theme that I think we shouldn't lose track of as we debate which strategy or which rule to put into place. Because it is hard to know. We have, as I mentioned, an enormous amount of research and experience with some of these policy rules, but there's no reason not to keep it up, and there's no reason to think about there's only one. And that's why I think the legislation that's out there is good in the sense it says the strategy is important, all rules is important. It's your job to choose the rule, central bank. But we want you to be accountable about it. Thank you very much. Some questions, I guess, huh? You do the questions.
Oh, no, well, yeah, we'll direct. We have somebody with a microphone. Oh, we had some. Yeah, there we go. Yes. Thanks, Yeshin. Come right here. So technically, this is our second Q&A period now, John.
Hi, Carl Gollivan. If I could ask your indulgence in asking a question in the context of an earlier rule, Roger Sherman, the framer of the constitutional provision, no state shall make anything but gold and silver coin a tender in payment of debt. And looking at it in the context of Andrew Jackson ending the second bank, out of concerns that a central bank would just inflate away the wealth of the laboring class by viewing that in context of the rule of Bretton Woods, where each nation was to have a redeemability in gold. What about the idea of making a geopolitically Iceland, of all places, a focal point where each nation would redeem excess inflation of its own currency in gold and then thereby balance or offset any inflation of their own currency against that of other nations to bring kind of a peaceful focal point that's not tied to Europe or the U.S., but between East and West, as it were?
Yeah, no, I think that's the kind of thing, I don't know if that's the exact way to do it, the kind of thing you're looking for. As I mentioned, my calculations are that you can come pretty close to that by each country following a reasonably simple, understood rule just for the interest rate. You could do it for the way you're talking about, I believe. I haven't simulated or tried to calculate it that way. But the beauty of that is that each country is doing their own thing that's optimal, and it's delivering a better global situation. I think that's what I think is missing now when we've deviated from any kind of rule at all.
Yes.
Yes, John, you haven't said much about the role of sanctions in regard to policing and enforcing a monetary rule.
Right.
And I wonder if you could comment a little bit about that. That is, what sorts of sanctions you think are necessary or desirable in order to make sure the thing isn't just on paper but is actually being adhered to?
That's a very good question. So my original thinking about this was that the public appearances, the testimonies, the hopefully informed members asking questions would be the way to enforce. You'd see if you were off or not based on coming up and being cross-examined. What I've found is some people want more than that. In fact, the legislation that I've referred to has more than that, has the GAO help monitoring this and checking on this. But again, there's still the enforcement that you mentioned, which comes into play. So I think it's an issue. And of course, some people, Alan Meltzer and others have even had more severe sanctions, but the personnel would be changed running the central bank. I still think that if our democracy is working right, that testimony, those presentations, should go a long way. But you do have to have an informed populace, informed people about it. So it's not just like it's willy-nilly. And I think that's hard. It is very hard. It's a very technical subject. It's hard to circle it's easy to circle the wagons on a particular issue. So it's a very good question. I don't think we've resolved it a lot. I think the legislation that's proposed is grappling with that, and I'd like to find a way that works better. But again, mine was a little, maybe you'd say, too mild. But for many things we do in our government, that is what we use. There's criticism now that there's no strategy in foreign policy, and there's hearings about it, and maybe that will help. But of course, it takes a while. But it's a very good question. I don't have much more to say than what I just said.
JW and then Jaime.
Professor Taylor, I want to ask you about J.W. Verrett, House of Financial Services. I want to ask you about the instruments of policy. So in the Fed's normalization strategy they issued late last year, I think it was September, they talked about moving away from the Fed funds rate for a short period of time, eventually getting back to targeting the Fed's funds rate, but for a time using the rate of interest on excess reserves and using the reverse repo program. So I just want to ask first, what's your view on that? I think folks would be interested in some of your concerns about that maneuver, and let's hope that's only temporary. It's temporary until it isn't. QE was supposed to be temporary. Stayed with us a lot longer than we had expected. But then second, if the Fed ignores concerns that folks have about that, can the rules-based approach be adapted to those new instruments? Kind of curious about those two views.
Yeah, so that's a very good question as well. I prefer if we got back to a situation where the interest rate was determined by the supply and demand for reserves in the market. There's a market-determined interest rate. That's how it used to be. There's to me, it's healthy to have a connection between those interest rates and the quantities, between money supply reserves and the interest rates. It helps on accountability. It's another check on what's going on. I think it's valuable not to move away from that. It also, I think, removes some ability to have a more interventionist discretionary policy in a way that's not helpful. So, for example, if the balance sheet remains high forever, above the supply and demand numbers to get an interest rate, so you're saving interest on reserves effectively to get the interest rate, then this balance sheet becomes another instrument, which I think is not productive to have as an instrument all the time. Is QE forever, effectively would be. You'd have QE forever, and your short-term interest rate would be determined by interest on reserve. So that also is concern to me as a political economy, or just an observer of government or a participant in government. That's not, I think, an ideal situation to be in. Of course, there's this transition where they're going to have to do that. But I think ultimately a goal should be to have supply and demand reserves depending on the interest rate. Now, if in fact they don't go that way and interest on reserves becomes the new normal, then it seems to me you could still have a policy rule applying to that. You could still have, say, something like a Taylor rule, whatever, applying to that just fine. But it brings in all these other complications as well. So I, again, prefer it not be that way. In my recommendations or writings, I've said don't have it that way. But also what happens, the transition to normal is going to be 5, 6, 7, 8, 10 years, who knows? And so that's such a long time, you can imagine that transition becomes a new normal. I hope it doesn't happen, but it's possible, in which case I think you still need to apply a policy rule to that rate.
Jaime Narbonne, Chairman of the National Economists Club. Dr. Taylor, my question to you is whether in your analysis of the Taylor rule or any other rules-based monetary policies you have taken into consideration the possibility that a mild deflation might occur that might actually be beneficial to the economic growth. This kind of deflation that occurs from innovation, productivity gains, and stuff like that. And I'm saying this because in our current discretionary monetary regime, basically any deflation is seen as negative, and with the 2% stability mandate, I'm wondering whether this is something that should be taken into consideration when prescribing a monetary policy rule.
I think it should be taken into consideration. And one of the couple of things to say about this, there tends to be a commentary that says if the inflation rate is lower than 2%, you have to put your foot on the floor and do whatever you can, the easiest policy ever. So it's frequently taken as, hey, the inflation rate just reported the last 4 quarters with data is 1.3%, I guess. And so that means we have to have a 0 interest rate. The Taylor rule says in this circumstance you have a 2% interest rate. It's not 0, it's not 4, it's 2. It's somewhat positive. But people forget that. They say, oh, the inflation rate's below 2. We have to just keep our pedal on the floor and accelerate as much as possible. And you read that, you see that, people talk about it. So the first thing is to clarify that if you're following a policy rule, you don't go to 0 just because the inflation rate goes below 2. It's basically you move it slightly lower than it was 2, but you don't go to 0. Second thing is in retrospect, quite frankly, are concerned about the way the 2% inflation target is being used. Originally that idea came in the Taylor rule, and the notion was that, well, a couple of reasons. One, there was the measurement bias in inflation, but 2, having a little more leeway in the interest rate. But now it becomes something that you're below 2, you're getting fears of deflation, as you're saying right now. And deflation itself is not necessarily bad, right? It could reflect, as you say technology. It could occur for a while. I think it's better if you're price stability rather than periods of deflation. We've had periods of deflation in the United States where growth has been strong in the 19th century. So here I think what you have to do is somehow smooth over these. They're usually going to be temporary. So in the Taylor rule, there's no notion of using a core inflation, which raises its own problems. By the way, a core inflation rate would help a little bit on that because you'd be temporary dips in commodity prices. But it averages inflation over a fairly long period of time to get those instabilities out of the system. But you raise a very good question, and I think we have to, again, the first thing is don't jump to conclusions when the inflation rate is going below 2. Second, there are periods, because say oil price dropping, where you're going to get negative inflation rates. Not the end of the world, but and don't overreact. Keep things steady, and I think it should be fine.
Time for one more.
I'm sorry, one more thing on that. You also, I think, this is part of my answer to J.W.'s question. Having this connection between the interest rate and money still seems to me important. And ultimately, you can go back, when you have a deflation, you can go back because you'll get the 0 interest rate, and you can rely back on money growth again.
Time for, I think, one more question here in the front. unless it goes really quickly, this will be our last one.
John, Warren Coates, very good to see you again.
See you.
Within the universe of policy rules, the Taylor rule is a monetary policy reaction function in implementing an inflation target rule.
Yes.
The reverse of that, which was typified by the gold standard, where the system is anchored to a particular price, then allows the market to decide what supply is needed in light of that price. What is your view about more modern real anchor systems, such as my real SDR proposal? As you said, monetary policy is difficult. Why not anchor the system with something real and let the market then make those decisions?
So can I answer that question in the context of a money growth target, which is similar, I think. You fix your money. You can back. To me, the way I think about that is to go back to fixed money growth, Milton Friedman. I don't talk about the SDRs. But in that case, it was similar to what you're saying. The central bank it just fixes the money supply or fixes its growth rate. And maybe you can do it with high-powered money. I don't know. You fix it. And then the interest rate's going to be determined in the market, right? You have supply and demand, money supply, whatever, determine the interest rate. And that's fine. In a way, things like the Taylor rule just sort of take that into account but focus on the interest rate. You can think of a Taylor rule as an inverted money demand equation, where you're taking the interest rate in money demand and put it on the left-hand side, and you put the fixed money growth becomes a constant, and you basically have the interest rate moving up if inflation picks up and up if GDP picks up. The coefficients will be different, but that's basically it. And so that reversal or inversion is how I tend to think about the fact of a policy rule working. It really is kind of like the market. It's not exactly because the Fed's setting it and it's setting the supply and demand to get that, but it's kind of mimicking it. Now, I think that you could think about your proposal in the same way. I need to think about it some more. What kind of thing would you be inverting? It's a little more difficult because the timing, you're getting the interest rates determined instantly, minute by minute, when you're fixing a quantity or another variable, and it takes time if the central bank is doing it, so it's more than that. But I think that's the way to think about it. I think you want to have your policy being as market related as possible. So this connection between reserves and interest rate in the Taylor rule is important to me. But I think I need to think more about the particulars of your proposal.
Okay. Thank you, guys. I think this can be the end of our program today. Thank you all very much for coming.